In this week's video, we'll examine the question, what is the hard data telling us now about risk? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. After a wild week in the stock market, it might make sense to go back and review the last 29 months that has been extremely odd relative to market history. We can hypothesize that it's the Fed and their low interest rates that skewed the market. Going back to March of 2013, this rally was nothing like anything we had seen since 1950, which means anything in my lifetime. Had to go back. This covers 65 years, the Vbottoms situation. Then, when we went into the consolidation period, we presented numerous never-seen-before stats over the past few months, including some never-seen-before in the history of the Dow stats relative to this consolidation period, meaning you can go back 115 years, and this type of action had never occurred before. The pattern remained intact this week. The speed of this drop has not been seen in 75 years. We have to go back to 1940. All of this is frustrating. However, this flush that we have here may be a silver lining flush where we get a market reset and one of two things happens. We either rally and we can establish a more normal uptrend, or we go into a longer-term bear market, which would also be a trend which is much, much better than what's happened year to date. This expression from our childhood can help us understand the risks in the present-day market relative to the risks in the last few years. These charts here are examples of some of that odd V-bottom behavior, something that we've never seen in our lifetime. Most of us. A V-bottom is basically when you get a pullback and soon thereafter you go on to make a new high. A pullback, a new high, a pullback, soon thereafter a new high. These charts can help us with two items. Number one is, how do we make decisions using the market model? And number two, what's the risk in the present day market relative to the risk at the lows during these V-bottom periods? Now we're looking at the same periods, the V-bottom periods, but we're looking at a weekly chart. The previous charts were daily charts, and now we're looking at the actual date of the low rather than the complete V-bottom cycle. Question number one, how do we use all of this? Do we just look at the charts and try to make a judgment call about what we should do, whether we should be patient or whether we should take action, or what should be the percent of exposure to stocks relative to bonds? Clients know the answer to that is no. It has nothing to do with making judgment calls. We take all of this and convert it into numerical values, always scaled between 0 and 100. So for example, at the low here in February of 2013, if you heard me say in a video that we can afford to be patient during this pullback, the reason was the trends were extremely strong. What this 100 tells us is, on a scale of 0 to 100, every single question that we asked about this chart came back with a bullish response. Trends relatively strong. At the low here, we can be patient. A score of 63 is still a decent score. Not too many disastrous things happen with a score of 63. It tells us to respect more downside, but that's kind of a we could go either way type score. A 98 is an easy leave it alone at this low, and a 59 is, and this is the V-bottom in October of last year, a 59 is we have to pay attention closely and respect downside risk, but we need to balance that with the desire to stay invested. And a 59 mathematically also allows us to scale back in relatively quickly after the low because the math is not that vulnerable. How does the exact same score look today? And these scores are part of the CCM market model. They're a sub-model. This isn't the final score that we use. The actions that we've taken since July 24th, where we've cut our stock exposure, increased our cash exposure, and added bonds, all of those decisions, there's nothing arbitrary about them. They're based 100% on math and rules. You can see this number 4 here. What does that tell us? This submodel here asks 207 questions, binary yes or no questions about trends and risk, which basically are asking 207 questions about bullish conviction relative to bearish conviction. The 4 tells us that 96% of those 207 questions are currently coming back bearish. And the rules require us to start taking action at certain levels. The rules require us to begin scaling into bonds as long as bonds can clear mathematical hurdles. That is also based 100% on zeros and ones and numbers. So for example, if we get to a period where inflation is a problem or the Fed is raising rates and bonds and stocks fall in unison, then the math will not allow us to own bonds, and the rules will require us to cut our bond exposure. Or if it was a situation like 1994, the rules would not allow us to ever take a position in bonds. So if we're posed the question, why did we do this or why did we do that? What is it based on? The answer is always the same. It's based on the observable evidence, zeros and ones and hard figures, and hard rules. And the rules allow us some freedom. But you get to a point where certain levels are broken and there is no longer any freedom or leeway, and you are required to take action. Why? It's based on rigorous backtesting and 20 years in the business as to what matters and what doesn't matter. This number here also tells us that we're in no rush to scale back in. This number, based on the evidence, needs to pick up. If it does pick up, then we are happy to increase our exposure to stocks. And any decisions relative to increasing our exposure to stocks will be 100% based on the facts in hand. This is the post from Short Takes this week about similar model readings. This is 2011 here. The point of the exercise is, remember the score, and this is actually a sub-model reading here. This isn't the master market model. The score today is at 4. Notice how long you can get low scores like that. Each one of these arrows is a day where you have a score that's probably between 8 and 0. So this does tell us to get ready for a potential turn. The caveat is we get scores like this at the early stages of a bear market as well. So we don't have to worry about trying to discern between the two. If it's a serious bear market, the evidence will never improve in a significant way. Rather, the evidence will continue to deteriorate. When we examine a chart like this each week, this chart really has very little to do with the math. Support and resistance in the charts are part of the implementation rules. They're not really part of the zeros and the ones. Example, if the market model begins to tell us that we need to scale into stocks. So let's say, for example, at the close today, that number 4 was a much higher number and it required us to scale into stocks. From an implementation perspective, we might be able to wait within the context of the rules to see if the market can clear these potential forms of resistance. If it does, then it would require us to take that step. If price fails to clear resistance, there's a short window where we can be under allocated until we clear this level. But that window at some point even closes within the context of the rules. Why? We can't drift too far from the 0 and 1 based allocations, because that is the basis of the market model. This is the daily chart of the S&P 500 as of the close on Friday, August 28th. You can see we had a plunge that we've not seen anything like in 75 years, which means I've never seen anything quite like this. However, I have seen lots of vertical declines, and we're going to cover some of those in this week's video. There is a basis for patience regardless of the math. Resistance here potentially. 2001 is the 50% retracement level from the drop that took place from point A to point B. 1969, we've already cleared that, but not for a long period of time. And the last fib is at 2032. It's possible that price will be rejected here next week, and it's also possible that price will break through to this level and be rejected, or break through to this level and be rejected, or we could go up and have another in a series of V-bottoms. If we can clear 2132, that would probably allow us to say that it was a successful V-bottom, the last high that we had. Did we learn anything at the close Friday? Yes, but before we cover it, I want to emphasize a single candle has nothing to do with the math and the rules. This is an implementation issue that helps you with timing. This is what's known as a hanging man. This is the textbook hanging man. You can see we've got the long tail and then somewhat of a head look here. If you look here, we've got a long tail and somewhat of a head look right at resistance. Typically, the hanging man is a bearish reversal pattern that can also mark a top or a resistance level. We are right at resistance. Any single candlestick, like a hanging man, requires confirmation from price. So we don't predict when we see something like this, it just speaks to the probabilities. So if the market model required us to buy on Friday, from an implementation perspective, this hanging man might allow us to defer that decision for just a few days to see if price can confirm a move into this area here. I wouldn't put too much stock into this candlestick. It's one piece of evidence. It's a relatively small piece of evidence, but it does align with the theory that this may act as resistance in the short term. It should be noted, too, that this might not be 100% textbook because we've got somewhat of a larger wick here. And I really don't care if this is a hanging man or not. It's not going to impact our decision-making process in a significant manner. You can see sometimes when you get something similar. Here's a similar look here, and then we had a short-term reversal. Before we close the video with historical corrections and what we can learn from history relative to keeping an open mind, let's talk a little bit about the frustrating market environment that we've been in. The CCM market model is basically a conviction model. When bearish conviction is high, it's pretty easy to manage through that because you get a bunch of zeros. When bullish conviction is high, it's pretty easy to manage through that because you get a bunch of ones. Here is an example of one of many charts used by the CCM market model. I'm using it because it's good for illustrative purposes. SPY relative to TLT is in the model, but it carries a very low weight. But again, it's good to illustrate concepts. Here's the ratio here. This is the 40-day moving average in blue. This is an example of relatively confident and firm bullish conviction. When the ratio rises, it's telling us that the conviction to own growth-oriented stocks is higher than the conviction to own conservative or defensive bonds. The model can see this. This is a trend, and it's relatively easy to get aligned with that type of conviction trend. It works both ways. Now, this is relatively easy to discern relative to the slope of the ratio that this is a risk-off period. And the model can scale away from risk and reduce risk and add value because this is a multiple month move where the market is starting to question its bullish conviction relative to its bearish conviction. Notice the slope of the line and notice the slope of the point-to-point ratio in 2010. The model can add value here because this is observable and bearish conviction is relatively high during this correction. Once the stock market bottomed in 2010, we had another period of relatively easy to identify bullish conviction. Now the ratio of stocks to bonds is clearly rising, and we have a trend that the math and the moving averages in the model can identify and allocate according to this trend. This trend went from September of 2010 all the way into February of 2011. In 2011, bonds started to outperform stocks several months before this waterfall decline here. Notice the slope of the line. This is a discernible trend, and we can see that we're moving from a risk-on period and rolling over into a risk-off period where the model can start to move from a stock allocation and gradually go to a more conservative allocation. Also note, here's a waterfall plunge here in the ratio, and the ratio doesn't bottom for several weeks. We often say when a bottom comes, the evidence won't miss it. What do we mean by that? This is the October low in the stock market. The ratio was in a downtrend during the correction, and then look at the observable evidence. The slope of the line bottoms and starts to turn up. This is bullish conviction here. The model can see it and it can allocate accordingly, and notice it lasts for several months. Around mid-year in 2012, the ratio rolled over, slope rolled over, point to point. Look at the slope of this line. The market model likes slopes. It doesn't like flat lines. When a ratio from point to point has a relatively steep slope, the longer that goes on, the easier it is for the model to A, identify it, and B, to allocate accordingly. The model likes a chart like this. Later in 2012 here, notice the slope gets flat and then turns up. And point to point, especially from here to there, notice the slope of the ratio. Relatively easy to identify mathematically. The moving average is not particularly helpful here, and that's why we diversify with literally thousands of inputs and questions. But notice the ratio point to point on this chart has a very steep slope that the model mathematically can identify, and it can identify the change. Then late in 2012, the ratio starts to rise again. You can see this point to point. That's a steep slope here. These charts will now help us illustrate a point about recent activity in the stock and bond markets and relative to the battle between risk on in general and risk off in general across all asset classes. Here's a better visual point to point of the slope. This is strong bullish conviction. Remember at the beginning of the video we showed that we've gone through 3 periods that were extremely rare relative to market history. Is there anything else that's been frustrating and difficult? The answer is a definitive yes. And before we talk about this chart, I just want to emphasize SPY relative to TLT is used in the model, but it carries an incredibly low weight. Why? It's helpful, but there are other things that are much more helpful. So if you're just following this chart relative to our decision-making process, keep in mind it's not a big part of that decision-making process. Now we're looking at the 50-day in blue and the 200-day in red. Remember, the market model likes slopes. This is bullish conviction here. This is a mess, and this is confusion, and this is consolidation. Rather than a point-to-point here that has a steep slope, we can draw point-to-point here for 20 months. From this point here to this point here, we don't have a slope. The slope is 0. For 25 months, over 2 years, point to point, it's a horizontal line. 25 months, point to point, the ratio is in the exact same place 24 months ago, 2 years ago to the day, as it is on Friday, August 28th. It's very, very difficult for the market model to allocate properly and to discern between risk on and risk off here. And here we can draw a point. The ratio makes no progress between this point here and this point here 18 months later. And even now, we've got somewhat of a mixed bag. The ratio is below the 200-day moving average and below the 50-day moving average in favor of bonds right now. However, the 50-day is still above the 200-day in favor of stocks. So this is still a very, very confused and mixed picture. If we take away the two charts and just focus on the point-to-point slopes, the model likes this slope. The model does not like this slope that we've seen roughly for 2 years now. This slope also tells us that our assets are at higher risk. There's a reason for this confusion here. The market can't decide whether the economy is strong enough to handle the Fed's first rate hike, or is the rate hike going to push us over the edge? Indecision and confusion equals higher risk. Conviction is lower risk. This is frustrating. I know it's been frustrating for people watching this video. It's been frustrating for us. However, this is not particularly surprising. What can we learn from it, and what do we have to do going forward to make sure that the frustration starts to clear? Having a 2-year period of confusion and indecisiveness is rare, but it's not unprecedented. For example, now we're looking at a similar ratio. This is risk on relative to risk off, the S&P 500 relative to the price of a 30-year Treasury bond. We're using this because TLT doesn't exist back in 1987 and SPY doesn't exist. So this is just a proxy. Here's a period of very high frustration relative to the battle between stocks and bonds. What is the moral of the story? The frustration is the bad news. Can't emphasize enough the importance of continuing to stick with the discipline. If you continue to implement properly, eventually these frustrating periods end. For example, if we were running the market model in 1987, and I was not, I was studying at Georgia Tech in 1987. If I was running the model, it would have been frustrating, but the game plan would have been to stick to the discipline. Why? The longer the consolidation, the bigger the move that you get in either direction once the period of consolidation ends. If you stick to your discipline here, which means all of us have to stick to our discipline and stay with the plan, and we have to execute religiously. Because if we do, eventually the math will alert the model with this steep slope that something is changing. The model can see this slope. It can see this turn up. And there's numerous ways for it to see that this period here is starting to look different than this period here. What happened in the stock market, because this is our ratio, from point A forward? Meaning, if I stuck to my discipline, what was my reward after the breakout? The answer is a 40% gain once the market decided that it preferred stocks over long-term bonds. And after the breakout, stocks did extremely well. Look at the slope here. Look at the slope here. You can visualize that your moving averages are strong here. This is a strong trend that the market model can see and allocate accordingly. From an implementation perspective, why is it relatively easy to follow the rules when that trend strength score is at 4 as it is today? The answer is we know that corrections can last a long time. Let's look at some visuals. The purpose of reviewing these charts is not to predict anything about what's going to happen in 2015. In fact, these charts will not influence how we operate at all. It's strictly to understand the reason to keep an open mind about all outcomes. If the evidence improves, by rule, we'll be forced to scale back in. If it doesn't improve, in a situation like this where we go on to make lower lows, we won't be able to scale back in. Sharp drop, counter trend rally, not unusual to be followed by a lower low relative to this low, rally, and a lower low. 1987, we get a vertical drop, a sharp rally, and then a retest of the low. Notice this occurs several weeks later, and we rally in here for several sessions and then go back and retest the low in early December 1987. 1990 S&P 500 daily, a sharp drop, a bounce for several sessions, and then stocks went on several weeks later to make a new low. 1994, a very sharp drop, a rally for several sessions, and then a retest of the low. A retest can include making a higher low, but you come back and somewhat retest this area, and if it holds, that tends to be a good sign. You may say these periods are different than 2015. That's true. That's true of all historical analysis of the stock market. 1997, we get a sharp drop, a rally for 3 sessions, and then a lower low. 1998, sharp drop, counter trend rally, sharp drop, counter trend rally that lasts weeks, and then a lower low. It's August, early August here is where you make the first low. You don't bottom until early October. 1999, sharp drop, counter trend rally, sharp drop, lower low, counter trend rally, sharp drop, lower low. 2004 was marked by confusion and volatility, a drop, a rally, a drop, a big rally. Look how long this counter trend rally lasts. These are individual sessions. So 5 of these make up a week, and then eventually we get another sharp drop. Here is the first low in March. We don't get the final low until early August. You may be noticing that V-bottoms are rare. They're not the rule. They're the exception to the rule. And that doesn't mean we might not be in the process of a V-bottom, but typically that's not the way markets bottom. Decline, rally for several sessions, and a lower low in 2005. One of the neat things to pick up here is the flash crash. Typically, 1987 and the flash crash, they're not one-day events. In 1987, you tank in October and you don't bottom until December. Here, the flash crash occurs in early May. The stock market doesn't find its final bottom until early June, and then it even comes back and retests that low in September. 2011 might be the best fit, months of consolidation, a vertical plunge, and then a mess. Here, the vertical plunge occurs in early August. We don't make the lowest intraday low until October 4th, 2011. 11. So the key to success going forward is consistent implementation during difficult and frustrating times. We have to keep a flexible, unbiased, and open mind. Why? We can't implement properly unless we remain flexible. This looks like a new bear market technically in 2011. The rules were changed by the ECB and a light switch was flipped back to risk on. If you're not flexible here, it's very, very difficult to implement properly. A V-bottom, a lower low, a multi-month correction, or a bear market. Doesn't matter, the math won't miss any of it as long as we maintain maximum flexibility. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.